Svagare makrosiffror från USA, högre förväntningar på räntesänkning från Fed igen och AI fortsatt i fokus. Med för att diskutera vart allt detta tar vägen har vi Rushabh Amin, Portfolio Manager at Allspring. Warm welcome, Rushabh.
Thank you. Good morning. Nice to be here.
Good morning. So all eyes on the US, AI, and now the next Fed meeting. Even if we don't have all the data given the shutdown, what state would you say as a whole the US economy is in right now?
Yeah, so the US economy is in quite an interesting position at the moment. So we, as you kind of alluded to, we haven't had much data so far, but we have had some kind of higher frequency indicators, particularly from the private sector. We believe that the labor market is effectively slowing down. Inflation is remaining sticky. But for 2026, we believe that the growth in the US will begin to slow, but from a very high base. So, so we still expect positive real growth for the moment. Inflation to actually re-rate much lower in the first half of the year, driven by rent prices, and for the labor market to continue moderating. And as a result, we do expect the Fed will likely deliver a slightly hawkish hike in December, and we remain to see what happens in March as the governor, the Fed board changes, which we believe will ultimately lean to be more dovish. And as a result, can unlock a bit more growth in the US economy. But at the moment, we think we're at an inflection point. We hope to see some good data coming out after the Fed meeting in December. Particularly, the focus will really be on the labor market at the moment.
So leading into my next question, how do you think that they will resonate given that?
Yeah, so it's going to be interesting. So over the last couple of weeks, we've had quite a number of Fed speakers kind of, being able to talk in their private speeches and so on and so forth. And you've really seen a bifurcation in the governor in the Federal Open Market Committee. It's split at the moment, almost 50-50. The markets are now pricing in a full cut in December, and we believe that they will ultimately deliver a cut. You can almost call it like a precautionary cut. And we do think the equity markets will like that. You start to see financial conditions easing slightly again. Right. But the focus is also at the moment on the balance sheet side and the quantitative tightening and how that runs off as well. So we believe that they will cut in December, but it will be a bit more hawkish at the end because you kind of have that perfect, almost perfect balance in the voting body at the moment.
And other than the big macroeconomic environment, there's also AI driving sentiment. What are your thoughts on evaluations there?
Yeah, absolutely. So valuations have been sky high, and they've continued to actually, get wider, as it were, in the sector. But you really have to break down AI as a theme into multiple different sectors at the end of the day. So far this year has been a story of AI capex, which is effectively the big names spending a lot of money in order to build out data centers and so on. And the equity markets are kind of pricing that into the valuation, looking forward 2 or 3 years ahead. Over the last six to 8 weeks, what we've seen is a bit of a reversal in that trend, right? So a number of names have been punished because of the spending. And kind of the question is, can they maintain this level of spending, and what will it ultimately translate into in terms of investor dollars, right? So we have had a number of earnings over the last couple of weeks in the semi sector. You've had a bit of a change also in who's leading the GPUs versus the TPU story starting to come out a bit more now as well. So we actually think from here, it's going to get quite interesting because this year so far, AI capex has been 1% of GDP in the US, just over 1% of GDP in the US. And that's actually more than the consumer. So that's actually a pretty big number. So the questions I think people are asking is, can this be sustained? If it's sustained, who is ultimately benefiting from that? Who's paying for the services? But for us at Allspring, we actually think the next wave of valuation expansion will come in the secondary sectors. So you have to think about what do you actually require in order to build out these data centers? So energy, real estate, beneficiaries of AI as well. So you have the healthcare sector in particular having done quite well recently. So we do think that the cash generation is positive, but the question is how much more spending can they increase? So valuations may be starting to look a bit shakier here, but given the macro backdrop, they could continue definitely to expand over the next 12 months.
And with all this in mind, what's your advice to investors going forward into 2026 in terms of equity and different sectors?
Yeah, absolutely. So on the equity side, we really see a nice kind of opportunity building out here. We're calling it going from AI 1.0 to AI 2.0, which is effectively moving from the semis into the beneficiaries and the infrastructure providers. So you have a number of sectors, particularly in the mid caps, but also in, as I mentioned, some of the sectors earlier, real estate, starting to look a bit more compelling, and energy, but also to look wider than the US, right? Ultimately, the entire value chain, the vertical chain, is, quite concentrated also in emerging markets, and we think there are good areas of opportunity there. So it's kind of thinking about how do we go beyond semiconductors into the rest of the value chain? So for us, that's, as I mentioned, SMID, real estate, energy, and those that are really adopting artificial intelligence and that theme very quickly. Healthcare comes to mind, but there are also a number of other sectors, particularly on the manufacturing and utilities front, that are likely to benefit from this trend going forward.
Thanks so much, Rushabh, for joining.
Thank you. Have a lovely day.
You too.